Hello everyone, welcome to Thai Finance. Today we're going to talk about the Warren Buffett's indicator. And everybody's saying that right now that we're in a stock market bubble. So if you want to know when is the best time to go out from the stock market and avoid a price meltdown in the stock market, you should definitely stay tuned because we're also going to talk about the Shiller indicator to contrast the information. If you want to watch more videos about investing, please subscribe, like the channel, and share this video to all your friends. What's up? So first of all, I want to talk about first who is Warren Buffett. Warren Buffett is an American investor, chairman and CEO of Berkshire Hathaway. He's considered one of the most successful investors in the world, and he has an estimated net worth of over 80 billion US dollars. And he's noted for his adherence to value investing, which is basically an approach of how to invest, and his accessible personality despite all his wealth. So I want you to take just a first glance of what we're going to talk about, which is the Warren Buffett indicator. The most important thing that you must note here is that we have cycles in this indicator, and it's very useful to know when is a good time to enter the market and when is a good time to exit the market. And I just want you to see where we are standing right now, which we are on a strongly overvalued stock market, okay, by historical trends. And before continuing, let's just get into deeper details of what is the Warren Buffett indicator. So the Buffett indicator measures the stock market capitalization to GDP ratio of a country, and it weights the size of the stock market to that of the economy, in this case the United States economy. So a high ratio indicates an overvalued market. It's very useful to have a point of reference whether the market is undervalued or overvalued. As we just saw, the indicator, it's basically telling us that the US stock market is currently strongly overvalued. And of course, we want to know when to take profits, right? And of course, that's if you can, because it's very difficult. So let's go back again to the chart. So here we have the historical trend line of what is considered fairly valued by the Buffett indicator, which is this black line. And of course, the Warren Buffett indicator measures the GDP of a country compared to the aggregate market value. Then we have some standard deviation lines under and above the fair value trend line. And we just have two lines, the overvalued, which is the first standard deviation, and the strongly overvalued. And below that we have the undervalued and strongly undervalued. And the way we calculate this, basically this indicator, is that we take all the aggregate US market value, which is around 48.9 trillion right now, and the current quarter annualized GDP, which is around 21.8 trillion. And then we divide those numbers and we get 225. And it's basically where we are standing right now, 81% higher than the long-term trend line. And this is telling us that the stock market is strongly overvalued. Well, what do we do now? And first of all, it's very, very important that you see that there are some cycles that it just go to the upside and then it turns back to the downside. And then it goes to the upside, and of course it will at some point go back to the downside. The question is when. It's just a matter of time that this crashes down. And another way to look at the valuation of the stock market is looking at the Shiller PE ratio for the S&P 500. The S&P 500 index, it's basically as well an indicator of the health of the US economy, because inside the S&P 500, we can find the 500 most successful companies that are running the whole economy. So here we have another one. Here you can see that the cycles go back and forth, and here we're indicating the most significant financial crisis in the 1930s, the Black Monday, the dot-com bubble, the Great Recession, and there's a high probability that we have another one, a big one. So the Shiller PE ratio uses the yearly earnings of the S&P 500 for each of the past 10 years. And this is adjusted for inflation using the CPI, averaged for 10 years to get a number. And how we calculate it, we take the adjusted price of the S&P 500 and we divide it by the result of the average of these values in a time frame of 10 years. And basically it's telling us how many times the earnings of the stock market are adjusted to the current price. And of course, if it's a high value, it signals that we're overvalued. And as you can see, we're above most all-time highs, except this one, which was the dot-com bubble. And we have to take into consideration that right now we have a low interest rate environment, and low interest rates boost the stock market prices. So here we have distorted values because the amount of monetary units that are issued by the Federal Reserve in exchange for treasuries. But the reality is that we have another economy, which is not the financial economy, the real economy. And because of the pandemic, we have continuing claims for unemployment insurance, and this is telling us how many people are claiming for protection. And this is a very high number. This is like 25 millions, and we are of course recovering, but we're far away from previous levels before the pandemic started. Then we have another impressive chart, which is the COVID-19 triggers a record wave of US corporate bankruptcies. And of course, we always have bankruptcies. That's why we see all these little lines that are other years. And here you have two lines. One of them is the dot-com bubble, the Great Recession, and now the one caused by the lockdowns and our panicked politicians. It was a huge impact for the US economy. And we see that, well, it's kind of difficult to see that the stock market is overvalued, but there are a lot of bankruptcies. So what do we do now? Should we go and take all our money from the stock market right now and run far away from the financial economy? Well, no, we have to consider an exit strategy from the market. We will never know when the bubble will pop, okay? Actually, it's very difficult to exit just at the market top. So the best thing that we can do is just take profits on the way up when we get significant all-time highs. And of course, you will never know when the market tops, so you have to as well take profits on the way down. So the best time to take some profits or take your money away is when the stock market is basically at these peaks, okay? It doesn't matter that you don't take all the profits here, but if you see that it's going up, well, take some profits and take some a little bit, and then you take some here in previous highs. Of course, it's very difficult, but this is a great way to mitigate your risk. Panic and fear are your worst enemies. And don't panic. We never know when the market will pop. It will be fast, maybe, but at the end we have to be very aware of what's happening. Try to educate yourself more, watch relevant information about the stock market, get financial advice from a professional, and invest the money you are just willing to lose. This is not financial advice at all. If you like this video, please share it with your friends because this is relevant information. Subscribe to the channel, hit the thumbs up, hit the bell button and all, because the YouTube algorithm works like that. And this is a good way to help me to get to more people and help them as well. Go and see the channel to see more videos about financial education, economy, tips and tricks, and risk management. Thank you very much and see you next time.